Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
So it's not often you can say inflation hit a 3-year high and the bond market didn't react that bad. Not often you can say that, but you can say it today. And today would be the Thursday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday. Unless, of course, I'm sick, on vacation, or it's Azalea Festival week, and it is neither of those things. So let's talk about inflation. We got the CPI reports, and it was almost exactly as expected. I didn't see any surprises. Annualized rate, monthly rate, core, what we were expecting. And so because of that, everything was sort of priced in. So when the report came out, rates actually, the 10-year was actually down, I think, a point after the report came out. It was like, inflation's at a 3-year high. And then the 10-year actually fell. So that was kind of impressive. So what were the actual numbers? Consumer prices had been adjusted. And that could be a reason why we've seen rates also move up. Is that originally, I think we were seeing about 4% by at least ahead of the report the night before. We had seen the official estimates were for a rise of 4.2%. So year over year, inflation is up 4.2%. That was up from 3.8% in April and is the highest level since April 2023. So that's over 3 years ago. Monthly basis was also not very good. It was as expected. Inflation was up, or prices were up 0.5%. So if you annualize that, that's 6%. So that's not very good. While that was slightly below April's 0.6% increase, it was still the second strongest monthly gain of the past 3 months. So, like I said, headline number as expected, but still bad. It's still a bad number. Inflation's at 4.2%. That's double, more than double the target rate by the Fed of 2%. So anyway, you look at it, it's not a good report, but because everyone was expecting it and everything had been priced in, you didn't see a lot of movement in the bond market. So the 10-year, despite the fact that it was really unchanged for a lot of the day, maybe up or down about 1 or 2 basis points, did close up almost 3 basis points. So towards the end of the day, you did see a little bit of movement there. We'll talk about the Treasury auction as well. And then Mortgage News Daily actually had the 30-year fixed rate falling 1 basis point. So like I said, kind of interesting that you just didn't see a really negative move because everything had sort of been priced in. We'd already seen that adjustment to bond yields on this expectation of this is what the report was going to be. So, of course, energy was the main cause of all of this, still the case. Rising energy costs, the energy index increased almost 4% just in May alone. That was slightly above April's gain of 3.8%, so 3.9%, 3.8%. Energy prices are now up 23.5% year over year. So that's a big jump, almost a quarter, 25% jump. And then gasoline prices have risen an eye-catching 40.5% over the past year. So we're all feeling that, no doubt about that. And that is really the main cause of all of this. According to the report itself, the energy index accounted for more than 60% of the overall increase in consumer prices during the month. Because you look at everything else, it's not really that scary, which is a good thing for consumers and everyone else. Food prices were up just 0.2%. That's still above the target rate, but much better than what we were seeing with energy prices. That was down from a 0.5% jump in April. And I think it was like the fifth time this year that we've seen a 0.2% rise month over month. Annual food inflation is actually edged down to 3.1% from 3.2% the previous month. So a little bit of cooling there. Core inflation, which of course excludes food and energy, the volatile parts of our economy, which is what most consumers deal with on a day-to-day basis, which is always very frustrating for a lot of people out there, because it's like, yeah, the thing that you're buying every week, we exclude from the inflation numbers. Core inflation rose just 0.2%, down from the 0.4% rise in April. And annual core inflation was up slightly to 2.9% from 2.8% the previous month, and was the highest level since September 2025. And then, of course, because this is a real estate mortgage podcast, shelter costs rose 0.3% in May, down from the big 0.6% increase in April. And year over year, shelter inflation increased to 3.4%. That was the highest reading since September 2025. So the takeaway is that energy costs are spiking that headline number, the top line number that everyone's talking about. But food prices, here's the good news. Those energy shocks, those energy spikes are not making their way into other products yet. Now, this is what they're concerned about. And this is what Jerome Powell mentioned when the war started, is that you could get to a point where eventually these companies stop eating these energy costs and start passing it on to the consumer. And we're not seeing that because everything else is sort of in line. I mean, sure, it's a little bit hotter than what they'd like, but manageable. And so the good news for consumers and the Fed and everyone else is that we're not seeing those energy spikes really filter, besides the direct cost of energy through electricity or, getting gas for your car or whatever else you need, energy for, the direct to consumer product. That's obviously, those prices are up. But we're not seeing other products really pass it on to consumers yet, at least not at a level that's having an impact on these major categories like food, core prices at all. Now, you can find certain categories in core where you are seeing some big jumps, but overall, it's not having a major impact. So that's kind of the good news, is that we still haven't seen it passed on, which means companies are thinking, hey, this energy shock might eventually go away, either just through kind of like with Russia and Ukraine, where it just became kind of normal that we were at war. And so the energy producers found a way to make it work and avoid the areas where that would be an issue, find new suppliers, whatever, new routes, whatever it may be. Or they're thinking, hey, there might be a compromise or a deal reached with Iran and things are going to calm down. But that was the good news from the report, because the top line number is awful. I mean, energy prices skyrocketing, awful. Nothing good there. And so the only good thing about the report is that outside of energy, you're not really seeing horrible data. So energy has not made its way. So that's the good news. All right, so what were some of the reactions to the report? President Trump, probably regret saying this, was asked if he was worried about inflation rising to a 3-year high. He said, quote, "No, I love it. The numbers were great." He went on to say, I love the inflation. When this conflict is over, you will see oil drop to where it was before. So, I mean, people are going to make fun of Trump for this, and I am by no means a Trump apologist. But what he's arguing is what I was just arguing, where he's like, okay, you remove energy, it was not a bad report. And this is happening with a solid labor market, right? 172,000 jobs last month. I think the month before was over 150,000. So we're seeing strong labor market data. And besides energy, we're not seeing really bad inflation, which is kind of like perfect storm. So that's sort of what Trump, I think, is trying to say. You never really know. But he's not entirely wrong. He's, of course, going to regret that I love the inflation. That's going to get played in every commercial once September hits for the midterms, especially in North Carolina. Get ready for that clip played over and over and over again on every television station, every YouTube channel you go to, radio for those that still listen. You're going to hear that a lot. So he's going to regret saying that. But the people that are making fun of him and, he doesn't know economics, I don't know if he knows economics, but his argument is not entirely wrong. I mean, if tomorrow energy prices return to normal, inflation would fall off. 60% of the increase last month was energy. So he's not wrong. But he's gonna regret that clip. I'll tell you that much. He is gonna regret making that comment. Nick Timrose, the Fed whisperer at the Wall Street Journal, noted, talking about the report, saying that the analysis leaves the Fed's recent hawkish lurch intact heading into next week's meeting, which will be the first under Chairman Kevin Warsh. The questions facing rate setters, there we go, are no longer about what any 1 month shows, but whether the disinflation or slowing the pace of price pressures they have expected is ever going to arrive, and what they do if it doesn't. For now, the debate runs from holding rates steady for longer to, at the margin, whether a rate increase belongs back on the table. That's a conversation that seemed unthinkable earlier this year when we began pricing in cuts. So, yeah, he's not wrong about that. I mean, so the good news for the Fed is that we're not seeing any sign of the energy inflation leaking into any other parts of the economy, as I mentioned. But at the same time, we all know that Trump wants Kevin Warsh to cut rates. And he can't. Not with 4.2% inflation, man. No way he can do that. Absolutely not. And then Ben Castleman over at the New York Times, also kind of negative tilt, noting the surge in inflation means that prices are once again outpacing wage gains. Average hourly earnings adjusted for inflation have fallen 0.7% over the past year, wiping out all the gains made in the early months of Trump's term. In inflation-adjusted terms, workers' pay is exactly where it was when Trump returned to office. So Trump's quote is going to hurt him in November. They're going to beat him up over that. And then, the pain that consumers are feeling, you can't do anything about that. So from a political standpoint, GOP's got some issues, no doubt about that. And I've always said, I said this when I was, more of a political analyst, you cannot tell anyone that the economy is good. They either think it or they don't. You can't convince them. If people think people don't have money in their pocket to pay for something, or they have to cut back or whatever it is, you can't go, I know, but look how good your 401k is. They're going to be like, I don't care. I don't care. That's great. That'll be great when I get the 401k, but I need the money now. I don't have it. And so they're going to feel like the economy's not that great. So yeah, that's going to be a problem for them. So it's not all rainbows and flowers and everything else. I mean, this was not a good report. Highest level in 3 years. Like I said, the only silver lining is it's just energy and remains just energy. We have not seen it leak into other areas. So that's the reality. And then speaking of good news, it's a very positive podcast today. We had a Treasury auction, 10-year Treasury auction, 9-year, 11-month note. Bid to cover ratio was higher. Always, you want to see that. Was at 2.57, up from 2.4 the prior month. So an increase there. And then the primary dealers, those are the people that, of course, have to buy Treasuries if no one else does it. Their share of the purchases at this auction were 9.5%, down from 12% last time. And we did see stronger demand because the yield was lower than expected, 4.538%. So all in all, having a Treasury auction same day as CPI and a strong Treasury auction is good news. No doubt about that. So a little more positivity there. And actually, let's end with some more positivity. Mortgage demand jumped for the week, almost 11%, even though rates increased. I'll take it. Refinance index increased 15% from the previous week, 20% higher than 1 year ago. Purchase index up 7% from one week earlier. There we go. Good thing I am ending this podcast soon today, not like total, because can't talk. Mike Frantantoni, chief economist, Mortgage Bankers Association, said mortgage rates were volatile last week as news from the Middle East continued to drive markets. While the average rate was up slightly to 6.6%, there were opportunities where borrowers were seeing somewhat lower rates, maybe govy loans, things like that, but up nonetheless. So even though we got a pretty bad inflation report, highest level in 3 years, the end game, or the conclusion, I should say, is it wasn't that bad. And you can see that by the bond markets. Up, but not that bad considering inflation's at the highest level in 3 years. 3 years. So, yeah, all in all, not that bad. All right, you guys enjoy your Thursday. We'll be back here for the final episode of the week, Friday edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.